Which criteria affect car insurance rates? Risk. Each company will have their own economic models which they will use to determine the cost of coverage. I have a few ideas of things which affect rates from what I have read. Insurance is about risk. Failure to tell an insurance company about a risk will most likely result in a claim being declined. Disclose as much as you can. Age. Young people have more crashes, thus higher rates. Gender. Ladies are safer, so lower rates. Your address. Some places are higher risk than others, crime, etc. Your previous claim history. If you have had lots of claims, you are higher risk. Previous traffic infringements. Inducements to join that insurance company like lower rates. Inducements to stay with that insurance company like lower rates, or not changing higher rates in the hope you will not shop around. Where the car is kept. Is it locked away? Does it have an alarm? Criminal record. The amount of risk sharing a policy that covers theft will cost more than a policy that just covers damage to third parties. The excess or deductible, which you have to pay if there is a claim. This saves money for the company because people don't claim for small damage and only big stuff. Remember, each claim costs money to process. Edit, the total maximum limit on the claim. If the company is only liable for a few $1,000s, then the premium is cheaper than one that covers $1 million, because the company has less risk. This is important because if you damage an expensive car, you may be liable for a lot of money which the insurance company will not cover because you are over the limit. Cost of covering claims. If the crime rate goes up, then the insurance company will have to pay more to cover the cost of the car. The value of what is covered. If the car is cheap, and it is written off or stolen, then there is less to cover. Ability to force lower repair costs onto the auto trade. In New Zealand, there have been complaints by panel beaters that the insurance companies are forcing them to accept unaffordable prices. The insurance companies have to keep a lot of money on hand to pay out claims. They don't just put it in a vault. They invest it. I understand most companies don't make money from insurance, they make money from the insurance float they hold. If the economy is bad and interest rates are low, they may raise rates to compensate. The amount of profit the company wants to make and the desire to have more market share. Declining insurance. While some places have a right to insurance, companies may try and remove high-risk people from their risk pool through high premiums in the hope they don't buy it from them, or just not offering the insurance at any price. They may also focus their marketing on the demographic groups they want to cover, such as safe lady drivers. Cost of doing business, such as wages, overheads, IT, etc. That is why some places have call centers in India, because it is cheaper there. Certain states allow rating on certain criteria, whereas others do not. In most states, the driver's credit score is used as well to determine credit rate. A few states do not allow credit score to be used, but insurance companies have found a good correlation between a high credit score and lower loss risk, but not income and loss risk. However, people with thin credit files or no hits are rated into a default bucket as far as credit score is concerned. PA, for example, does not allow the insurance company to adjust rates based on gender. PA does, however, have limited versus full tort options which can change your premium. People who elect to buy limited tort insurance are waiving their right to sue for pain and suffering in most cases. CA is one of the most restrictive states for auto insurance rates. They force premiums to be calculated on years of driver experience, driving record, zip code, and vehicle. Age. Some companies are noted for having a huge drop in insurance premiums when a driver turns 25, and others drop their rates more gradually as they realize there is less of a difference between 24 and 25 than 16 and 25. Rates also tend to rise when a driver gets older than 55. Some insurance companies also have OBD monitors that you can plug into your car to monitor your driving habits. They will offer you some discount, maybe 5%, just for using the device, with the promise of a discount up to 20% depending on your driving habits. The patterns they have found in general to be most predictive of loss risk from this are time of day. Night driving is worse, possibly because most people are out of sync with their sleep schedules, and hard braking. Interestingly, vehicles with higher horsepower generally were lower loss risks. The people who drive higher horsepower vehicles are usually fairly careful with their vehicles and pay attention when driving. Their accidents are more likely to involve just themselves, as opposed to involving other vehicles as well. Also, people who had gotten one traffic ticket recently were deemed to be slightly lower loss risks for a several-month period of time, even though they were charged more for getting the ticket. Thing that will influence your auto insurance rates will vary from provider to provider. But in a nutshell, your current age, the age at which you began driving, your driving record, clean, accidents, moving violations, previous insurance claims, your credit score and history, the area where you live. Auto insurance is state regulated. Neighborhood crime statistics matter too. Garaged car versus open area parking. Academic history. Some companies give discounts for a student's defensive driving or driver education courses. Not all give discounts for these courses. Group discounts. Military, credit unions, alumni associations, employer groups, etc. The car you are driving. The newer the car, the higher the rate. I recommend you shop around. If you have any blemishes on your driving record, make sure to talk to a live person if there are any circumstances that could affect your rate. Currently, insurers in India use limited number of variables for insurance pricing. It would depend on cost of your new car, its engine cubic capacity and the geographical area where it is used. Higher engine capacity attracts higher premiums as much as use in cities, metros with higher traffic density, because both these variables contribute to increased probabilities of accidents. If your car is old, there is a depreciated value for which insurers would cover the risk, and higher the age, lower the insurable value and consequently lower the premiums. If you are a relatively careful policyholder who has not made claims in the past, you would be eligible for no claim discount, which can go up to 50% for 5 continuous years of accident-free driving. However, in Western markets, insurers use complex models, taking into account more variables like vehicle make, state province of use of vehicle, driver's age, accident history, marital status, driving experience, annual mileage covered, etc., while computing premiums.